Good morning. This is Rob Barnes with Integrated Insurance. Today's topic is term insurance details that matter. We're going to get right into our program. Today we're going to discuss that there's more to term insurance than the price alone. We want to address how consumers are shopping these days for their term insurance, share some creative designs, tips, and tools. We've all made purchases before, and the reality is that price and quality are at sometimes two ends of the spectrum. If you want quality, you often pay more, and that is true with term insurance just the same. And so, what do we look for with term insurance to know quality, flexibility, and their riders? So to start with, for quality, we look at what the financials and the ratings of the insurance carrier are. We look for what their historical performance has been. Do they have a comprehensive product portfolio? Some companies today are term specialty only and they have nothing for quality permanent to convert over to. And of course, carrier reputation matters. And that's something that in my position, I have a little bit better understanding of than the typical client that we deal with. And so let's talk about flexibility with term insurance. What does that mean? Well, we want to know what happens after the level term period. We want to know if there are conversion options or conversion limitations in the policy. We want to know if they allow us to reduce the face amount later. Many of the term specialty products don't. And so, what we do know is after the level term period, some policies will expire or terminate. Others will lower the death benefit substantially, and this is becoming more in vogue with more carriers doing it. But the typical and most policies tend to turn into annual renewable term after the initial rate lock. So to take a look at it for this 40-year-old female, she's paying $620 the first 20 years, but in year 21, her premium is expected to jump to $11,600. Now, some carriers have a guaranteed maximum and they might increase the premium, but not to the maximum. But often we see the typical thing is the carrier is going to follow what's in the contract and increase the price to that. Now, what happens in the 19th year? For this lady if she finds out that she has terminal cancer. Now, certainly she's going to pay those ART premiums, but what if she had one of these policies? What if she had a policy that doesn't increase in price, but it substantially reduces the death benefit after the rate lock period of 20 years? So in this situation, if she did have that incurable cancer diagnosis near the end of her policy, it would be very valuable that this policy have some kind of conversion option that held out for the 20th year, because certainly we would do that. Now later, I'm going to share a real life story where this was a vital situation for two business owners, just so you know when we get to our client chronicles. So conversion, the things we look for there is how long can I convert? What are the options I convert to? What limitations do they hamstring me with? And as we look at the duration of conversion, most carriers will be the end of the rate lock or age 70. There are some carriers that go to 65. There's a couple that go to 75, but the typical out there is it's convertible for the full lock-in period or age 70, whichever comes first. However, carriers have started to strip down and go a la carte on their term. They understand that if somebody provides a quote, a spreadsheet for you, a lot of people are just looking on price. And so how do they get a lower price? Well, they don't allow you to convert it to as long as the other companies do. So a 10-year term or a 15-year term might only be convertible for 10 years. A 30 might only have 20 years to convert. And some carriers, again, they're going a la carte. So you have to add a rider if you want the full 15 or 20 years of time to be convertible. Now, The conversion options, as far as what's in the client's best interest, is that they don't get hosed by the company later. Some carriers bait you in with a low price, and then if you need anything later, they're going to hose you because they don't have a conversion option, or they have a very poorly priced, high priced conversion option for it. So what we look for is the top, which is optimal. We want the ability to convert to any policy that the carrier is selling at the time the client wants to convert. And that gives us the least amount of chance of getting hosed or paying higher than we would have. Some carriers today allow the good stuff for 2 to 5 years, and then after that, they have a quote unquote conversion policy. And again, there's some carriers that have full convertibility, but then they have a second term policy that's not convertible at all for a little bit lower premium. Now, this is hard to see without some examples. So let's use this 40-year-old female, on the bottom, we can see the pricing for carrier 1, 2, and 3 for the 20-year term. And the quality conversion is carrier 1. If this lady decided to convert right before the policy rate lock is ending in 20 years, she could convert to something for 15,000. Now, carrier 2 looks better, and for the first 5 years they are, but after that, you can see that the price was almost double if we're converting, and carrier 3 has a substantial increase in cost. So, the idea is to pay a little bit more now and keep your options open and have more flexibility for the future. And some situations with your clients demand a higher quality coverage because the future isn't as clear. These are high income people, these are business owners, these are the ones that are most likely to value quality term and have full options available. Face reductions, you might automatically think that you can reduce the face amount of your policy, as some companies don't allow it at all. So they know that if you started with 3 million of coverage and you only want a million 15 years into the policy, they're not going to let you lower that. So you're going to replace them, assuming you're healthy, or you might have to convert and strip down a permanent to convert just the amount you want. Most carriers do allow you to convert whatever portion you want with minimum. So again, these are things we like to know in the contract. So the choices for face reductions is a amount of reduction or a percentage of the death benefit is something that they'll only allow a certain percentage to be reduced. Some of them allow a limitation for policy years or a combination. So as an example, in the first 5 years, we can decrease 35%, but after that we can't decrease, or we can decrease more if we wanted to. So Stephen Covey teaches us, begin with the end in mind. And so we're real good at all the marketplace and what we can design, and what we need from you, the advisor, is you need to tell us if your client is intending to buy a 30-year term, but they might want to reduce it in 20 years if things go well for them. Those are good components of the design that are good things to share with us so we get you the right thing. So are we going to carry coverage longer than we first thought? Is there a chance that the plan doesn't go as planned and they need the coverage longer, or just want the coverage longer? Do they need to reduce later? Are they intending to convert later? Because that would potentially change what term plan we would want to place to allow that best conversion options for them. And in some cases, they're just looking for price and that's all that they care. And we'll show some layering in our unique designs later where we do some of both and have some options for quality and lower our overall price. So the riders that we can have on term insurance, again, I mentioned that more and more we're seeing these conversion extension riders. If you want to convert it the whole rate lock period, you have to add a rider and pay a little bit more. You can have waiver of premium. This is if you're permanently disabled, they'll pay the term premiums. For some of our our best quality carriers, not only would they waive the premium, they would allow you to convert the permanent, and they'll waive the permanent premium with waiver on certain term plans. You can add spousal and child term riders on with some term carriers. And just a little sidebar here, there's a few carriers that allow you to insure all your kids and they don't underwrite your kids. So if you have somebody who has a disability as far as a child and maybe they can't go buy regular life insurance, maybe we add a rider to a term policy on one of the parents. So just keep that in mind. And accelerated benefits, living benefits, these are more and more included with different policies. There's one in particular I'm going to highlight, our CICA rider, the chronic illness conversion arrangement, and I'll address that in a minute. So these accelerated riders, they can be utilized for critical illness in some cases. These are think the Aflac duck here. If you have certain things happen to you, you might be able to collect some money off your life insurance policy. Chronic illness is a long-term care alternative. If you can't do two of the six activities of daily living, you might be able to collect benefits off your term. And then most policies these days offer some kind of terminal illness. If you're expected to die within the next 12 or 24 months, they will let you get some of the death benefits. So for some people, maybe they want to quit work early and their terminal illness rider allows them to get some cash to be able to do that so they can spend the rest of their life with their family versus working. So accelerated benefit riders, on the board here, the companies A, B, and C don't include any specialty riders. You can see that we happen to have three carriers that are, priced exactly the same. That happens sometimes. And then we have a carrier that's priced the same with company D, and they have some inclusive riders. So all things equal, these are things that you like to do. Now, blue collar workers who can't buy good disability insurance and might work in higher risk jobs. I like some of these products in orange for them because they usually, often they either can't get quality or they don't buy disability because of the expense factor. And so when I'm picking out what term, carrier, and product to place, sometimes I want to go with company D versus A, B, or C for them because it has an option that might be a valuable thing to have later in life. But the one I want to spotlight here, which I'm a very big fan of, is Company F, and this is the CICA rider. And, I was at a NAPA convention a few years back and was sitting in a class about long-term care. And somebody asked a good question, what do I do with my younger people? They're not ready. A 40-year-old isn't ready to start talking about being decrepit someday. But hey, it could happen tomorrow. And I'll talk about that in a minute. But in this case, using this company's term product and adding that special rider protects their insurability to be able to get a long-term care option, a permanent long-term care option later in life. And so this is the Mary story that I tell people. The CICA rider is a call option on her health. So if Mary buys the policy at age 40 and 5 years later, she has tragedy strike, she's in a car accident and she's neck down paralyzed, not waist down paralyzed. Now it's important that she has disability coverage because that replaces her paycheck. But if she's neck down, she's going to need care. And in addition to replacing her paycheck with disability, what's going to pay or who's going to pay for her care. And that's when this rider could be a golden situation. Now, those events are few and far between. What's more likely to happen to Mary is in the 18th year of the policy, she's diagnosed with MS, and she was in the home stretch of retirement planning now at age 58, and she wanted to get some long-term care insurance, but she's not going to buy the good stuff with a diagnosis of MS. But with this policy, she can convert and get the rider and have life with rider option of long-term care. And, at the end of the day, if she's healthy in 20 years, she wants coverage longer, she can go out and apply for any term insurance she wants or any permanent or long-term care. And you could look back and say, well, she overspent a little bit on her term, but that's hindsight. And we don't have hindsight. So with our kit, we'll send you a little video that talks a little bit more on quality terms so you can grasp that better. So let's take a look at how consumers shop. We're partners with advisors, and I work with licensed and unlicensed advisors, fee-only advisors, and such across the nation. And I know that a lot of people think different on the subject. There's a lot of opinions on it. So what we do know is that the primary source for people to get their life insurance is through work. And it's real easy to get life insurance through work, especially as a new employee. Just sign here, put your beneficiary, and here's what we'll pay. Here's what you'll pay for it. There are solicitations. I'm going to show you I continue to get AAA solicitations for life insurance. There's career agents, such as your State Farm agent. It might try to pivot to your life insurance situation if you're getting auto insurance with them. Some direct-to-consumer companies follow with this as well. Of course, there's the internet and the 1-800 Buy Your Life Insurance programs. But we fall into this last category as an insurance broker. So I want to go through each one of these with you to give you some insight of the issues at hand and how we think that, using an insurance broker is certainly worthy to improve outcomes for your client. So first of all, group insurance. A lot of people think different than reality on this. They think that because they're buying in a group that they're getting a discount. And the reality is the people that are healthy are subsidizing the unhealthy people because there's no underwriting or very limited underwriting in certain situations. And then the lack of portability, the lack of convertibility, the options you'd have to convert to, all those things shine in favor of an individual term policy versus group. But people aren't doing the math here. So I want to run through an example. These are real term pricing situations. In fact, I think this is one of the government programs, if I'm not mistaken, that we have this term pricing from. So at somebody age 45, a male buying a 500,000 20-year term of coverage, if we do the math through all 20 years, because these products are banded in 5-year intervals for most group. I haven't seen a group plan that's not banded in this way if it's a pure group term policy. So note that over 20 years, their average monthly premium is $217. Well, if we underwrite and they're just standard non-smoker, we're $85 a month. And that's going to remain level the whole 20 years. So we're cheaper today and we're going to be cheaper tomorrow. And of course, if they're better than non-smoker, there's even a more drastic savings of premium. So the younger your client is, the healthier your client is, the more they should consider replacing any group term that they're personally paying for. Of course, if my employer is paying for it, hey, it's free to me, and I'm okay with that. I probably couldn't exchange that anyway. But if you're paying, you have one of those programs that are 2 or 3 times your salary, we should look at individual for their own good. So do the math. You have more control, portability. You improve your conversion options. You might buy one of those terms we just looked at with some living benefits in it. And one of the pieces we'll share will be our integrated insight, where we address this, and you have some of these numbers to study as part of the kit. So the next place we get solicitations, these come from the mail, the radio, the has-been movie stars that might be on a late night commercial telling you to buy insurance there. But again, there's no free lunches. These things are often either a simplified issue, sometimes a guaranteed issue, but they're certainly, it's rare that they're fully underwritten policies. And so this is an example of the solicitation I get from AAA on a regular basis, although I just dropped my card with them because of we have new cars and coverage under that nowadays. So with this, note that if I can say no to these 3 questions, I'm highly likely to be approved. Now, there's a few other questions as well, but these are the big ones that'll knock you out immediately. And one of the things I want to note here is that they don't ask if I'm a raging alcoholic or if I have a myriad of other health issues. So, of course, it's priced into letting unhealthier people in the group. Now, I'm neither a raging alcoholic nor am I 45 years old any longer. But again, just comparing, the rate would be $56 a month from them. And if I were just standard risk, it'd be 42 and locked in over the period of time. Now, just for full disclosure, AAA did come out with a true level term. And you'll see the price differential still is in our favor. The healthier and the younger you are, the more you should look at individual quality term from brand name life insurance carriers. And when we look out at career agents, again, I work with career agents that are allowed to go outside, but some are captive, like a State Farm agent. He only has the arsenal they allow him to sell. That's 99% of the time State Farm products. And State Farm's a good carrier, I won't say that, but they only have one product. They only have one underwriting offer. And they don't have a plan B. So if they put a client through underwriting and they're rated or decline, client's got to start all over again somewhere else because that isn't transferable information most of the time. And again, so I have a career company in here, a quality carrier that we know that does well. And I also have a couple of no agent, no commission situations. Now, this is an evolving world out here, and I understand that some people in the fee-only community consider commissions evil, but commissions are just part of the distribution process. If they go direct to consumer, they have to have a whole infrastructure to support that. And the reality with life insurance is nobody's successfully done that I'm aware of right now. In fact, for those that, there was a direct to consumer situation. Mass Mutual set up something underneath them, and they've already closed that down because it wasn't successful. And if you're aware of TIAA-CREF, TIA used to have some non-commissionable term and permanent products, and they pulled those off the market as well. So it tells me that as usual, this is a gruesome conversation with people. Not many people just go out and buy it on their own. They have to be push, pulled, and prodded to get the coverage on there. But just wanted to address that for our fee-only people on the call as well. And so now we'll turn our attention to the internet, where everybody is Superman or Wonder Woman when they go on and price things for themselves. And so you'll see in a few minutes, our process starts with pre-screening clients' health because we know what goes on, and we know there's many variables that can throw you off of what you see from those online things, and Ethos is a carrier that is out. They only have a few carriers in their arsenal, and they always show you a young person very healthy for a 10-year term and tell you can get coverage for $1 a day for a half million, whatever. But it's a little bit of a bait and switch realistically when you're not talking about, very few people. Only about 20% or so, up to 40% with some carriers get their best rate class. And so when you're off track, that's when shopping and what we do matters even more so. So Clark goes on the internet here and he actually gets to the question about build, and we discover he's like me, he's rubber coated steel, not the man of steel. And so his price with his build here triples almost. And, that's not a good way to manage expectations. And for Linda, Linda went on the internet and she used her goal weight instead of her current weight. And then she finally admits that, hey, when she's out with the girls having a glass of wine, she likes to smoke a cigarette here and there. And all of a sudden, her price goes from about 500 to 3,500. And so, managing expectations, as you know, is very important with your clients. We take it seriously. And we're going to make sure that we do our full process for them and manage expectations from the gate. Now, some of the 1-800 Buy Your Life Insurance, they can do a good job, especially on younger, very healthy people. But when they get off track of health, that's where we think we shine better. Um, can you imagine sending your clients to an 800 number to start talking about their beneficiary arrangements or the how they should own the policy, especially for business owners or large estates and so forth? These are not the places to send those kind of people. We think that we are the right place to send those kind of people because we have a tremendous amount of experience and knowledge and resources. So these they'll struggle more to shop cases when you have stuff. We just we're I'll just mention this briefly. It's probably going to be a client chronicle someday in this presentation, but we had a client who 2.5 years ago went to the fee only place when they were available. The client was declined. They didn't have any other options. No screen was done up in front because we could have, solved all this stuff perhaps or not went into trouble. But we finally, after 2.5 years, have an offer for this person. And it isn't anybody's fault. What the person was doing was their own fault and stuff, but we finally came out with a success. And we tried a few places along the way, got some other declines, and client was resistant to even go this last go around, and we found a different reinsurer that's insuring a couple of term carriers, and they looked at his past in a different way, and so we had a success. And now, as long as he continues to distance himself from the events of the past, we'll come back and get that rating reduced or reapply and get better price coverage elsewhere. So we think that an experience, at the heart of what we do is make your clients professional shoppers. My uniqueness is that I'm not only own IIC, which we built to work with the fee-based, fee-only communities. I'm on staff at a national insurance brokerage operation with a lot of carriers, a lot of resources and support. And we're also a multi-line broker, which I think is important when you have clients. There are some specialty players out there that work only with long-term care or only disability. Well, we work with life, long-term care, disability, and fixed annuities. And so as an example, all four of these product lines for the long-term care protection world, I can add riders and features or buy certain products that cover long-term care in the life and long-term care and disability and annuity world. So if we're looking for long-term care, it's good to know all of the options that are available. And if somebody's buying both life and disability, we can use the same underwriting and minimize the effects for your client as a multi-line shop. And so we hope that it's very obvious that using an insurance broker like us makes sense. Our right fit process is something we share out of the gate with your clients, whether you connect us or whether you go through or start the process yourself. Again, I work with licensed, capable agents just the same, and I'm always in the background. But if you're some licensed people, we do all the work and split revenue. In the case of fee only, we can get all the work, and we're never going to bite the hand that feeds us because this is all we do. Just insurance, just these four product lines. We know our place, we know our part on the team. And so pre screening is where it starts. We then have education and design, then find the right fit. We get into the application process, the underwriting process, and policy placement. And we provide a kit to the referring advisor. We're here to work with you and your clients. How you want to work with us, as little or as much as you want to be involved, is fine with us. That's why we named ourselves Integrated Insurance Consulting. So it's your call. How should your clients be shopping? Who should they be going to? If you're not proactive, then maybe they're just working off solicitations or the internet and they're not getting what they could have gotten had they worked with us to start with. So we're here to get them exactly what they want or as close to it if it doesn't exist. So if you came in a few minutes late, just a couple of housekeeping. At the end of the program, we need you to log 50 minutes, so make sure you stay through some of the Q&A. I'll be somewhere around 50 minutes for the program, then I'll do some Q&A. If you have questions, please put those in the questions box and I'll get to them. If I can't get to them in the full hour, I'll follow up with you in the next few days or early next week to answer your question, or we can set a time to discuss any client situations you want. Or how we work and additional information. So when you close out of the presentation, there will be a survey there. We appreciate you filling in the full survey, but at least give us your CFP code or know if you're not a CFP. And if you don't have time after this, then in 24 hours, you'll get an email asking you for the same survey. If you've done it, ignore the email tomorrow. If you haven't, please fill that in. So we're not chasing you down for your CFP code. And I want to emphasize as well, our first half of the year presentations will end on 5/13 with long-term care, what advisors need to know. And so let's get into some creative designs with term insurance. We'll look at layering and adjusting term and term alternatives, temporary perm, and trust alternative ideas here. So Jill is a high income earner in her family. She came to me with a recommendation of getting $3 million of term. We looked at a number of different items, and as we talked through things with her, her family and her advisor, layering term made sense for her. So instead of just buying a 3 million 30-year term for 2,800, we bought some 10, 20, and 30, and we saved the difference of that 28 versus 1,900. Now, in this case, they ended up actually buying a quality term for the 30-year term, and that's the longest duration should be that. And so instead of the $1,011, she ended up buying the term with that CICA rider, excuse me. So it was $1,260. So she spent $150 more than the total here, but wanted to keep things fair. And we actually placed a quality 30-year term and then just used cheaper term for the 10 and 20. The thought is, of course, is as her savings grow, as her remaining working years lower, as they accumulate more, they won't need as much protection, and that's the design that we did here. So with it, there was a cost savings. We diversified coverage, made the longest duration quality. And this overcomes plan restrictions when you have these carriers that don't allow face reduction. So that was something that I asked there. You're going to always want the 30 years. And it was stated, well, we expect to lower that. I said, well, then layering makes even more sense. We'll just drop the 10 or the 20 at times. And we still had some convertibility with the products we did there. So next idea here, longer duration term. There is 35 and 40-year term products from a couple of carriers, but they're limited at what age maximum you can sell them at. And so sometimes I get somebody older that wants coverage longer than the typical 20 or 30-year term. So we might use a guaranteed universal life design and strip it down to last till age X or year Y. So these are just creative things that, again, it's always best to give me all the puzzle pieces, tell me what you're trying to do, what the goals are, and let us be the product experts and know who to draw from and how to design things for your client and yourselves. A term alternative, this is Hero. Hero was doing some estate and business planning. He was invoking some GRATs at the time, an advanced estate planning scenario. And he wanted the coverage to last for 20 years in case he died during the GRAT. It unwinds or reverses essentially. And so at his age of 71, there was no 20-year term policy out there. So we made one. We took a guaranteed UL, stripped it down to a 20-year guarantee, and the price was 14.6. We did show him, just in case he wanted coverage a little bit longer, we did show him a 25-year design at 17, but he ended up moving forward on the 14.6 in this situation. And a lot of people don't know this, but a few carriers allow off-year term policies. And so occasionally, when I'm doing business designs, I've got three executives and they're different ages, and we want coverage to go all the way to age 70 for all three of them. We were able, the typical term years are 10, 15, 20, 30. There are some carriers that have 25-year term. But in this case, we used a carrier. It worked for the underwriting on the case, but it especially worked for the pricing. We were able to get coverage exactly to age 70 for all of them. And that was a savings between the 5,300 and the 61. And so over 20 years, that's 15,000 extra in their pocket because of the way that we design things for them and knowing what the market can hold. Now, this next one gets a little bit more clouded, but bear with me here. At a 60-year-old, I'll tell you the point and the purpose. Sometimes permanent insurance can be a better buy than term insurance, especially at older ages and certain health brackets. And so this was a situation for a 60-year-old that was standard rated, wanted a 20-year term. We showed a quality 20-year term, and the out-of-pocket costs would be 43,000 over the 20 years. If they didn't die, they lose the 43,000. And so what we did do, some permanent policies have a return of premium feature in them. There are still a couple of companies that have return of premium term, just so you know, but these worked better than what we looked at with them. And the bottom line was we showed two options. One where, hey, policy A is going to be 4,000 instead of 2, and after the 20 years, you'll get your half of your money back. And that netted out to be a little bit better. And there is an advantage to these because what if they wanted coverage for 23 years or 27 years when they get 20 years down the road? Things change from the plan today. And so what we showed as well was a different permanent policy that was even higher priced, but this one gave us 100% of our money back after the 20 years. But let's look at the other parts of this, the flexibility, the what ifs. What if they wanted to keep coverage 5 years longer? The term policy turns into annual renewable term. So the 2,000 jumps to 10,000 and it jumps up accordingly. And over 25 years, they would have spent about 200,000 on the coverage. The second policy, the permanent with option A, you'd pay instead of four, it'd go up to 9,100, but your total out of pocket is 126 for a 25 years of coverage. That's better than 199. And the third option would keep the same premium of the 5,100 if they want to keep going forward. And that total just slightly higher than option A, but here's where that shines. What if, again, they decided they're keeping coverage a little bit longer? I contracted some condition. I know I'm dying sooner. Life insurance becomes more valuable when your health deteriorates. And so in this case, with the permanent policy B design, they would continue to pay that 5,100 instead of even higher premiums for the other two options. So these are just things to know, to be aware that they're stuff that we can design, and we don't expect you to know or remember all this. Just give us all the puzzle pieces, tell us what we're trying to do. That's where we go to work and make your clients and you expert shoppers. So, a trust alternative. Sometimes when you're doing estate planning, there's a kid that has either disabilities at times, or they might have a problem, a drug problem, a gambling problem, and the parents don't want to give them a lump sum. So they often will go out and create a trust so that they can control the inheritance after they're gone. And you may or may not know this, but every life insurance policy, it'll pay out a lump sum, but it also offers other options within the policy to pay out over time. And some policies allow us to design this up front and have a premium savings. So in this case, for this 30-year term policy for this 55-year-old, we were able to place coverage at 4,300 for the policy instead of 6,600. The face amount is 673, but the reality is it's going to pay over time. That's where the discounts coming in. Instead of giving you $1 million up front, I only need 673 and turn that into a 30-year income of 33,000 a year. After that, a 34% savings in the premium, but also a savings of not needing the trust, because this just pays the income and doesn't allow them to get the lump sum and squander it away through gambling or whatever the issue might be. So just again, creative designs, that things that you might want to know. So as I take a breath here, we're talking about quality term, and I have a story that when you see orange with our stuff, they're client chronicles where we know most or all of the details to the situation. This case started a number of years back. I was introduced to two business owners by a fee-only advisor, and at the time, they were just starting to formulate continuity planning between the two business owners. And the one thing that I did, as I usually do, is I offered them the different flavors. We can just go with strictly term. We don't call it cheap here. You can have quality term, or you could have quality term with more, and that's those living riders. And so these business owners understood that they were only putting a band-aid on their situation. They absolutely wanted quality term. And lo and behold, 5 years later and down the road afterwards, it became, with hindsight, a very valuable thing that they spent a few dollars more for quality term because they ended up needing the situation. You see, 5 years in, one of the partners became diagnosed with a life-shortening disease. And we diversified. They bought 15 million of coverage on each other, and we diversified between two carriers. And carrier A was an ART after the rate lock, and carrier B was a rate reduction. So when we looked at things, we kept an eye on things from the fifth year in, and the client didn't die in those first 5 years after his diagnosis, but he was sliding down the hill. And we knew that for Policy A, we didn't have to convert this one. We could have just paid the annual renewable term policy, and we show you what the premiums are for years 11 onward. But it made sense to convert this one because we were able to substantially save by stripping down a permanent and mocking a term. And we were pretty safe in our design, saying we don't think he's even making it a few more years, but in case we're going to design for 10 more years where we're pretty sure he won't be around any longer. And that turned out to be true with hindsight. And policy B was the most important one. Had we not had a conversion option on this policy, the death benefit would have went from 7.5 million down to 783. So this was the one that it was imperative to convert to and maintain the 7.5 million. And just through the way that the conversion policies worked, we funded this over 5 years, but it was going to run for 10 years. So we actually did a few years after, I think it was the 12th year or something like that, the guy actually passed and all proceeds were paid out. And it just gives you a real world example of how important it was that we had convertibility of any type and knowing what happens after the rate lock. Sometimes you do want these lower death benefit things and sometimes you don't. So some term tips and tools that we'll share some of these in our kit with you. You'll get a copy of the recording. Again, post some questions in the question box as I wind down here, and we'll get to those. And we first want to, our pre-screening process, I really hate to quote anything on anybody until I've screened your health because there's so many variables that I know that different carriers go by. And so, do you have a primary care physician? For these days, some older clients, if they don't have and haven't seen a primary care in the last couple of years, they could be as healthy as a horse, but they're not going to get coverage with some carriers. Other carriers, so this is the bait and switch that we don't like to do. Other carriers look to have they quote super preferred pricing, but some of the health of their family could cause them not to get that. So some carriers hold it against you if your parents or grandparents, even in some cases, have had cancer, heart disease, or stroke. Others may do it if they've died from that before certain ages, but these are all, we continually update our pre-screen form as new things come along, and we'll share a couple of those with you. So we want to ask, have any immediate family members had these issues? Did they die from it? What was the resolve on it? Having a bad driving record can cause you not to get the best rate classes out there. But these are some of the issues that we deal with the most these days. Certainly weight. Cigars, marijuana is a big one that's ever evolving. Let me just tell you that there are non-smoker rates available for marijuana users. We can now even get if somebody works in the marijuana industry, I have a couple of companies that have turned around now and they'll offer some kind of coverage there. Maybe not what you want, but offering anything that we can get you. Chewing tobacco is not the same as cigars, and certainly smoking cigarettes makes you a cigarette smoker most of the time. But we even have a carrier, if you are Linda and you have an occasional cigarette, we can still get you non-smoker rates with one carrier that has a special program. And so this is just our experience shining and things that we need to know in order to best serve you and your clientele. Medical conditions, of course, we ask about cancer, diabetes, cardiac. I don't want to quote somebody who quote unquote has diabetes until I know certain things about the diabetes situation, especially the A1 and the control and all those. If you have certain risky avocations or if you're a pilot, those can cause us to go to certain carriers over others, or you're going to be rated more. I know we worked with a rock climber a few years ago, and we were able to get them coverage, but it certainly wasn't off the shelf pricing. And then nowadays, and this is ever evolving too, as the world's in disarray, foreign residency or foreign travel matters. So we need to know where you're going, how often, and so forth. And those are all things that we just want to get it right the first time if we can, is the bottom line. We want to be as accurate as we can on the process and managing expectations. So that's why I don't like to just show super preferred to somebody, even though we might think that. So there are programs out there where you hear you can get this amount of coverage with no underwriting and so forth. Look, there's either guaranteed issue, simplified underwriting, accelerated underwriting, or full-blown underwriting. Again, we'll tell your client what carriers have accelerated underwriting and can maybe avoid them from going through the typical blood and urine. But the pre-screening that we do helps us know that those are available, or helps us gear them to the right carrier where they're going to fit that thing, and we'll be able to successfully avoid the typical blood and urine. When you're looking at term insurance, again, we suggest that you replace or supplement group coverage. As we talked earlier, the younger and healthier your clients are, the more that's true, and the larger amount of term they have at work, of course. But can you imagine discussing per stirpes or in equal shares to somebody on the other end of an 800 number? You know, client service is not good in most places. I'm shocked when it is, and I keep the names of those people. Now, again, being on staff at an insurance brokerage operation, I have inside access at carriers. We know good underwriters. We know good service people. We know carrier reps that can help us get things done that a client or a typical agent wouldn't be able to access or doesn't know about. You know, the Goodman rule is something. When you have more than three parties to a life insurance, it might be something that becomes taxable later. If you don't look out for that and stay away from it, later that might be something they call a lawsuit. And then employer-owned life insurance rules. Very few people are working in here. So when you're reviewing term, we want you to look out for carriers that have participating term policies. That has to be factored into any potential replacement. I saved somebody recently. They were ready to replace a return of premium term that only had 2 years left. I'm like, you don't want to replace this. In 2 years, they get all their money back. They won. You might buy some more now and pay a little bit and have more than you want, but you don't want to replace that. There's term UL policies out there that really are permanent, but they look stage one as term. Those have better value than some other policies out there. And some term policies, even though the client doesn't want them, instead of lapsing them, we should look at life settlements on those. Those are all things that, you know, it's just standard par for what we look at and look out for. Upgrading coverage, either extending out coverage or increasing their coverage or adding more benefits to their coverage, that all might be things that we'd want to do. And we do track term around here, so we know when rate lock expirations are happening, when conversion options are ending, and we'll reach out to you, the advisor, to let you know about these things in our system, and then you can either have us connected back to the client or not. Our kit is going to include an article that I wrote for NAPFA magazine a while back that enhances some of what we're covering here. Since then, I've made that quality term video, and it's on our YouTube channel. We'll send that link. You know, for those, I understand you need a price sometimes just to give a clue to a client. And so we do have $1 million term quote engine. What I don't do, or quote sheet, I should say, what we don't do on this one is we don't show super preferred. So rates could be potentially 20 or even 30, 40% lower than standard rates at some carriers, but it's managing expectations. We don't want to show you something that you don't qualify for or can't get. We do have a piece that we send our quotes out to clients with, where this right fit term policy, where we talk in lay terms about flexibility, future insurability, conversion options and stuff. This is helping them understand why they might want to spend a few more dollars and get something quality versus the strictly term. So hopefully I've shown you that there's more to term than price these days. Begin with the end in mind. Give us all the puzzle pieces. Let us build and show you what's available that fits or is close to what you can do. We can get creative here to hit all the parameters. Supplement or replace group term when available. We shared some unique term policies, designs, and riders for you to keep in mind of what we can do. We want to manage your expectations, and we hope that you consider working with us as life experts with unique access and a proven process in the field. So there's a picture of my mug for you. And as that comes up again, if you came in late and you didn't log your 50 minutes, please do so and stay on through the Q&A. And so somebody, you're welcome on the person who said thankful or thank you, you're welcome. Somebody is asking about clarity on the Goodman rule. Okay. And we find this most in the business world. So the Goodman rule says that there's three parties to a life insurance policy. The normal rule to live by is whoever the owner is should also be the beneficiary, right? We can insure the non-owner employee, key person, or a husband can buy on his wife and be the owner and the beneficiary of the wife's policy if we're doing stuff that way. But where I typically see this is we have the business own the policy, we have the insured as the spouse, or excuse me, we have the business own the policy, we have the owner be the insured, and we have the spouse as the primary beneficiary. So now we've got three parties there. What that likely means is that's an income taxable distribution to the spouse when the person dies. So what we could have done in place of that is we could have had the business own and be the beneficiary of the policy on the owner or key person, or we could have maybe should have just had it be personal insurance to start with and either have the owner own his own policy and be the insured and the spouse be the beneficiary, or we could have had the spouse be the owner and primary beneficiary with the husband, in my example, being the breadwinner and the insured. So that's an example of the Goodman rule to look out for. Again, when you see more than three people involved in a policy, it should wave a yellow flag. And these are things sometimes we pick up when we're reviewing that people didn't set these up. The other business thing that I see most out there is they did not comply with the employer-owned life insurance rules. For the last, I don't know, I think it came in, I forget the year at the moment. My brain's working faster here. But for quite a while, we've had EOLI laws, and essentially they say that if you don't document, disclose, and report policies that are owned by a business, and understand that's even a sole proprietor. If I'm a sole proprietor, or in my case, I'm an LLC with IIC, if my company owns a policy, I have to document, disclose, and report. And if I don't, the death benefit might be deemed taxable. And if that happens, that might be deemed a lawsuit for the agent involved because they didn't clarify or other advisors involved with the client. So, I want to thank you again for your time today. We're just a few minutes at the hour. If you've logged your 15 minutes, you're free to go. Hope you attend on 5:13. If you would like us to speak at your agent, your office, agency, or your study group, please reach out. We do CE on a regular basis and have a number of courses. We will be picking up our presentations in the fall again. Outside of on May 13th, will be our last first half of the year presentation for long-term care. So I thank you for your attention today. Some of you are already doing business with us, and those that aren't, I hope that you consider us as an option in the future to better serve your client protection needs.